I'm Grant Walker. Welcome to Last Call for Thursday the 9th of July. I'll be back with Heads Up Friday 10 a.m. To aged care funding. Analysis from Craig's Investment Partners says a big shift in how care beds for the elderly are funded could boost long-term returns for listed aged care companies. The new funding model will mean the elderly paying cash up front for their care beds through an Occupation Rights Agreement, or ORA, mirroring the process in retirement villages. Craig's analyst Stephen Ridgewell says an ORA for an aged care bed could cost about $150,000 to be refunded minus a deferred management fee when a person leaves. He says we believe returns on capital will need to increase in order to encourage private providers to build enough extra aged care beds to meet the demands of an ageing population and avoid a bed shortage. The most likely route is the introduction of refundable bonds. Mr. Ridgewell says under current conditions the sector will face a bed shortage by 2022 at the latest. Currently, most elderly people requiring rest home care pay ongoing fees, with district health boards shouldering most of the cost. About 87% of those patients have their fees partly or fully subsidised by DHBs under an industry-wide deal called the Age-Related Residential Care Agreement. The subsidy is means-tested, and people with assets of more than $218,423 must pay the full weekly fee for their rest home bed of $875 to $962. The extra cost of more advanced hospital or dementia care is fully funded by DHBs. Mr. Ridgewell says that funding model delivers pre-tax returns on capital of around 8.4% for the best operators, based on a build cost of $125,000 to $150,000 per bed and maintenance costs of 3.2% a year. He argues that's not enough to encourage more care beds to be supplied. He said industry net supply growth will need to increase by 250 to 550 beds per year to avoid a shortage. It's unlikely that the integrated retirement village operators will be able to make up the shortfall alone, and standalone aged care facilities will likely need to be built. To encourage extra supply, returns on invested capital will need to increase to be in excess of the cost of capital for at least some operators. He says introducing ORAs would potentially more than double the return for the best operators from 8.4% to 18.6%. Mr. Ridgewell says the main beneficiary of a move to ORAs would be Ryman Healthcare, who has increased his price target from $7.92 to $8.39 on the assumption that 30% of new beds in New Zealand are tracked in ORA. For more on this, nbr.co.nz. In market news, credit checking agency Vida Group has replaced its New Zealand managing director and is cutting jobs in New Zealand. Asked to confirm reports of 25 to 30 layoffs, the company's Australian spokesman, Victor Lueng, said only that the company was making a number of changes to its staffing and operations in New Zealand. He said these changes entail a recalibration of where we direct our energy and resources and enable a more focused program of investment in key areas such as product development, sales and marketing capability. These changes, he said, are specific to our New Zealand business to position Vida to serve our customers in meeting regulatory demands and serving their customers in an ever-changing competitive landscape. Mr. Lueng said New Zealand Managing Director John Roberts had retired and was being replaced by Australian executive Carol Chris, who starts work in Auckland on Monday. Mr. Roberts told NBR he could not comment on the changes at Vida because he was no longer the Managing Director, but his departure was not a recent decision. He said, I've been working on this for 12 months. Vida, formerly known as Vida Advantage, is owned by ASX-listed Vida Group. For the year to June 2014, the New Zealand business reported revenue of $54.6 million and net profit of $8.8 million. Vida floated on the ASX in December 2013 after an IPO of shares by private equity owner Pacific Equity Partners. PEP exited its remaining stake in February this year. Back to China, two Chinese firms with New Zealand links suspended trading in their shares yesterday to avoid further selling as market turmoil continued. Shanghai Pingxin subsidiary Hunan Dakang, which wants to acquire its parent company's New Zealand dairy farming assets plus Lochinvar Station, halted trading on the Shenzhen Composite Index, as did Being Mate baby and child food company, which Fonterra owns an 18.8% strategic holding. Both Hunan Dakang and Being Mate shares have more than halved in value in the last 3 weeks. Fonterra paid 18 yuan a share, or the equivalent of $780 million in March, for its stake in Being Mate, whose shares are now worth about 12 yuan, having previously sold as high as 30 in May. In February, Being Mate reported a 90% drop in operating profit in its preliminary result for the 2014 financial year to 65.7 million yuan compared to 721 the previous year. Revenue was also down by 17%. Meanwhile, Hunan Dakang has multiple applications currently being assessed by the New Zealand Overseas Investment Office. These include an application for them to acquire Shanghai Pingxin's interest in Crayfer Farms, a pending purchase of Lochinver Station for 88 million, and the management rights over Pingxin's interest in Sinlay Farms in Canterbury. Other deals include a proposed $22.75 million purchase of a third dairy farm business near Taupo and a $42.7 million planned acquisition of a Northland dairy farm business. The complex arrangements between Hunan Dakang and Shanghai Pingxin, controlled by Chinese billionaire Jiang Zhaobai, are understood to have caused delays to the approval process, leading to some speculation that it may miss a funding deadline. China's stock market rout could add further uncertainty. Yesterday, Hunan Dakang notified the Shenzhen Stock Exchange of a trading halt to safeguard the interests of investors and avoid abnormal stock price volatility. The company noted that it's planning to acquire overseas properties.
NBR Radio with Bayleys, New Zealand's leading commercial real estate company.
NBR Radio, Thursday the 9th of July. I'm Andrew Patterson. Welcome to Ask Me Anything. And joining me today, Tim Reid, Chief Executive of MYOB. Welcome, Tim. First question to you comes from Chris Keel. Your prospectus said MYOB would make a statutory loss but a pro forma profit this year. I associate the term pro forma with the 90s tech boom and dot-com hype, which of course ended so badly. Why was it so liberally deployed in your ASX filing?
So there's a few things that change between our statutory accounts and our pro forma accounts, and they're very important ones. The concept of a pro forma, when you put it in a prospectus, is it gives a realistic view of the business as it is today and rolls that both backwards and forwards. So there are a number of changes to our business over time which affect that pro forma. The biggest one is when we went through the IPO a couple of months ago, and it was a great time for our business and a very successful moment for our business, is that we used the funds raised to change our balance sheet. So we effectively went to the public markets and raised some equity and used that to pay off debt. And so when you're looking at the business, what the pro forma does is try and make sure that static things are the same and roll it both backwards and forwards. So the pro forma takes our equity and debt position today and says what would have the business's historical earnings been if that was rolled backwards, and how do we see them rolling forwards. The second big change is that over that time period we've made some acquisitions. And so the pro forma takes those acquisitions and says, what would have these financials looked like if those acquisitions were a part of MYOB for the entire pro forma period? And so again, rolling it backwards and of course rolling it forwards. And what that means is the pro forma shows the operational performance of our business. So revenue growth, for example, can't come through acquisition because that's there right at the start. It has to be the operating performance of the business that has driven that. And so those changes are put into the pro forma so that investors have the opportunity to really see the business in its current state, what it would have been like historically, and for 18 months, what we project the future will be like. So they're a more useful set of numbers.
Do you believe you've been as transparent with those numbers as you could be?
Absolutely. In fact, we had auditors go right through every number. It's quite a grueling process to go through an IPO. Of the process that first you go through internally, then you get external auditors to come in, and the auditors are putting their names, and in our case, Pricewaterhouse, to those numbers, and then you put them out to the regulator, and the regulator asks whatever questions they would like. So those pro forma numbers are exactly as stated. They're a very, very good view of our business, both historically, present, and our forecasts for the business going forward.
So also from Chris Keel, very broadly speaking, Xero and MYOB are both worth around $2 billion and both have around 500,000 paying customers. Xero is the company that's pure cloud and makes a loss and pays no dividend. But says that obviously it's got growth potential. MYOB still has most of its customers offline, but says it will make money this year and pay a dividend, how much will you make and how much money will you be paying out to shareholders?
Yeah, great questions. So we are a profitable business. We have very profitable operating cash flows every year, and that enables us to reinvest in the business and also allows our customers, investors, to have confidence that we will be around for the long run, because in many senses, profitable businesses control their own destiny, and those that chew up cash and that burn cash have to keep going back and raising more money and making sure that investors' appetite is there for the money. And again, back to your first question, Andrew, around what we learnt from the dot-com days, we know that those winds can change quite quickly. So for us, the most pure form of profit to measure in a business like ours is EBITDA, and we will make approximately, give or take, but in the order of $150 million of EBITDA over the next 12 months. We then, from that, have CapEx, so the investment that we make back into the business, which will take up about $20 million of that. We have to service some of our debt, which round numbers put another $20 million or so on that. What we've said is that we will have a payout ratio from our NPAT-A, which is our net profit after tax, adding back the amortisation of intangibles, because that's a non-cash issue. We'll have a payout ratio of 60 to 80% of those dollars. Roughly speaking, that means it'll be a $50 or $60 million in dividends that we'll be paying, and we'll still have in that order of funds available to reinvest in the business after we've done all of our product development, which is currently running at about $45 million investment. So it's a very healthy position for a business like ours to be in.
What about the fact that effectively you've got quite a bit of private equity in the business, and they will be wanting to exit presumably at some point? Isn't a lot of your motivation at the moment around your share price, getting your share price up?
Well, I think that every CEO of a publicly listed company has to work to make sure that they are creating value for every shareholder, whether that shareholder is a retail investor, whether it's a fund manager, or whether it's a private equity investor. They all own the same shares in the business. There's not different classes of shares. There's nothing that's treated differently between them. So a CEO's job is to be a long-term steward of the business, to make sure that the business is doing great things for its customers, and by that and through that creating value for shareholders. You're absolutely right. Bain Capital own 58% of our ordinary shares, so they are the majority shareholder.
And they have indicated they want to exit.
Every private equity firm ultimately exits their investment, and absolutely. But they've also put guarantees around the fact that they're not going to dump our shares. So as a part of the IPO process, they signed up to say we will put our shares in escrow for a period of time, which really effectively runs through to our earnings results post June 30, 2016. So they will be on our register for a long period of time.
But you don't think that creates an overhang for you at the moment?
I don't. I mean, when you have a private equity business, there's two choices when you go into an IPO. One is that the private equity firms sell everything, and people can get nervous. That means they're dumping a company that they know the inside workings of and that they're running for the doors. And that's certainly not the case with Bain and our business. In fact, Bain didn't take any money out of the IPO through selling of equity. All of the funds raised were effectively used to sell down debt and repay debt. The alternative is that the private equity firm holds on, as they have here, and then there's the concern of the overhang that you're talking about. What Bain have done in North America, where they've done a number of IPOs with their businesses, is have a sell down over an extended period of time in quite steady, digestible amounts by the public markets. And so my expectation is that that's the way that they would approach things in this case.
Okay. Chris Gill goes on to ask, earlier this year, Xero's Australia boss, Chris Rudd, went on a colourful anti-MYOB rant. Among other things, he said that the operating is in one particularly marked Australian is not a sustainable business model. Revenue from just two countries has to sustain all of MYOB's product, and some of that R&D is wasted on online desktop products which he doesn't see as viable. Is it? And why doesn't MYOB expand particularly outside of Australia and New Zealand?
Yeah, so lots of questions in there, and let me try and tackle them all. The first is to your earlier point that we are cash flow positive. So we're investing $45 million a year in R&D, and we are a very cash flow positive business. So I think there's a little bit of throwing stones here, and one should be careful of being in a glass house when your business is burning money and someone else's is actually making money. But if I think about the broader question, is it sustainable for a software business in our category to operate just in the Australian and New Zealand markets? We absolutely believe so. There is no doubt that being an online platform provider, which is both what we are and what Xero is, of business tools to small and medium businesses, that you have to get a certain number of businesses onto that platform to be able to afford to invest in and manage and maintain that platform. We have 500,000 paying clients. That is more than enough for all of the requirements to fund and to grow that platform. I would actually turn it around, though, and say it's a distinct advantage for us because if you look at where we need to invest, what we have to invest in is the needs of New Zealand businesses and Australian businesses, and we can funnel 100% of our funding into that. If you look at companies such as Xero, who are going after a global footprint, what they have to do is understand payroll tax laws, not just in the US, not just in Texas, but also in Houston, because in the US, cities levy taxes on employees and on income, not just states, counties, and the nation overall. So there's a massive amount of requirement for funding, which brings absolutely no benefit to business owners here in New Zealand that is being put on businesses that take that approach.
So really, you're saying that you want to be an Australia-New Zealand specialist?
Yes. Absolutely. And we are big enough that we can fund that. And what that means is you see more innovation coming from us than you see coming from our competitors at this point in time. I mean, I think about the Smart Bills feature that we rolled out in our software late last year and early this year, which means that a small business owner who receives an invoice from a supplier, most of them get it as a PDF attached to an email, can simply forward that on to us. We put an image of that in the accounting software and use optical character recognition technology to extract the pertinent information and pre-populate the accounting software with information from that bill. You know, that's something that our competitors don't offer in their software today, and it really is the fact that we can be much faster and much more innovative by focusing on the markets that we're focused on than having to worry about all of those compliance requirements that a global business does.
Okay. Question from Harvey. He says Xero was closely involved in the introduction of the New Zealand business number and also facilitating direct invoicing between Xero customers. What is MYOB currently doing to bring accounting in the modern age, and where do you see the future of accounting software going?
Great question, Harvey. So we're also very involved in the New Zealand business number. One of our team members is on the steering committee for that initiative. We think it's a fantastic initiative. Anything that allows us to streamline and digitise business really adds to the overall lowering of the burden of running a business. So it just means that business owners can be more efficient, transact with one another far more seamlessly and in a streamlined manner. And that's great for competitiveness in the New Zealand economy, because anything that we can do that means all businesses gain just means the economy overall gains. And we are in a global world today, and New Zealand businesses do a great job competing on that global platform. But initiatives like the New Zealand business number make it easier and will help business in this country become more competitive. So we are very, very supportive of that. Where do we see the future? We absolutely see the future online. So our investment is going online. Today, about 2/3 of new customers coming to MYOB purchase an online product from us, and we are all in. We think that it's going to move to a mobile world. When we look out there and look at the way that we as humans are interacting with technology today, what it's doing is meaning that we do many more tasks per day. We multitask more, but each of those tasks are broken down into smaller and smaller discrete elements. And mobile devices really facilitate that. So we've got a big push on understanding the overall end-to-end business process that our clients are involved in and breaking it into the little fragments that they might want to interact with, such that if they've got 30 seconds free when they're waiting somewhere to meet someone, they can get 2 tasks done. And that's really where we see the future of accounting heading.
Okay, question from Brian. It's quite a long question, so I'll see if I can abridge it a bit. He says, it appears to me that the market valuations on some accounting software companies like your own cannot always be justified by cash flow alone. Despite the fast-growing rates, the overwhelming number of companies in this space means that the current pricing to end users of cloud accounting product is unsustainable in the immediate term. Can you explain what unique advantages MYOB has which justify the valuation of its stock in the capital markets based on cash flow, and explain how your cloud offerings are different from those of your competitors?
Yeah, wow. There's a lot of questions in there. So the first thing to say is that when we went through the IPO 8 or 12 weeks ago, we went and met with 200 fund managers around the world, starting here in Auckland, but Melbourne, Sydney, Singapore, Hong Kong, London, New York, Boston, San Francisco, Chicago. We met with investors all around the world. And investors with that level of sophistication do want to invest in businesses like ours on the basis of cash flow. And so the two main metrics that they looked at were really our PE ratio, our price to earnings ratio. So it's the price of our shares based on the net profit after tax. And the second was our enterprise value to EBITDA. Both of those you can really only use for positive cash flow businesses, and they're both based off the cash that gets generated to shareholders. So absolutely, you can justify our share price based on those cash flow metrics. You can't do that with all of our competitors because they don't all make money, but for our business, you absolutely can. Shareholders, we're looking at companies like REA, like TradeMe, like Seek, like Iris, looking Tech One in the local markets. Those are the sorts of comparisons that they were looking at. And if you look at those, then you can absolutely understand why our shares are priced the way they are.
All right. Sorry, just carry on there.
No, I think there were 3 parts to Harvey's question. You might need to remind me, Andrew,
sure,
of what the second and third were.
So he also explained the unique advantages that MYOB has which justify that valuation.
Yeah, absolutely. So I think when you stand back and look at it, we are based at being a growth stock, and that growth is based on the fact that we are adding more subscribers every single year. Why are we doing that? Well, new businesses are being formed. Many of those businesses are choosing to use MYOB products, and that's what's leading to the underlying sort of 10% year-on-year growth in our paying user base. So that's where that's coming from. I think there was also an element of price, and him more or less inferring that competition over time would drive down price. Price is a very interesting one in our category. But what we don't see are the cheapest products gaining much market share. What we see is the providers that people trust, the providers where people believe that they are making their business life easier, where they're really automating functions, are the ones that are gaining market share. And we have, over many, many years, it's been 2.5 decades for us, price has not been the number one decision-making criteria in which accounting software to use over the past 2 decades, and there's no indication that it is today. I think what people want to do is get good value for money, and they want to make sure that they're getting more and more value every single year. So if I think back just to the feature that we released recently that I spoke about earlier, Smart Bills, that's saving people time because it means they no longer have to manually enter information from invoices that they receive from their suppliers. It's a massive productivity driver, and we simply bundle that in and make it part of the existing subscription. So the onus is on us to make sure every year our clients get better and better and better value from our products, rather than necessarily saying that they're going to become cheaper and cheaper and cheaper. And what we've observed is companies that do that over time win the market share in this category.
Question from Joseph. MYOB recently brought 2 payroll companies, Pay Global and Ace Payroll. Can you explain the valuation methodology and the basis MYOB used? Yeah,
absolutely. Great questions. Both great New Zealand businesses that we're very proud to now have be a part of the MYOB team. So when we look at acquisitions, we look at them on three sort of criteria. Firstly, the first type of acquisition we do is one that I call a strategic acquisition, and that expands our business into some area that we haven't been in the past. The second would be one that allows us to deepen our relationship with customers. So there might be customers or categories of customers that we already serve, but it allows us to deepen the relationship we have with them by adding so we've got two products that we're selling to them rather than one product. And the third would be some sort of innovative new technology that will help us accelerate our plans to market for something that we're planning in our existing roadmaps. So if I go back to the two acquisitions that were mentioned, PayGlobal, which is a business that we acquired last year. PayGlobal provides human resource management and payroll solutions to larger businesses. So businesses that might range from, say, 50 employees up to, we've got businesses that have 10 and 20,000 employees that run PayGlobal today. Indeed, MYOB has been a long-term PayGlobal client because we use it to pay our 1,200 staff across New Zealand and Australia. And so that was really a strategic acquisition. It expanded our platform into more than just payroll, but human resource management, and expanded the size of business that we provide those types of solutions to. The second being Ace. Ace Payroll is another great New Zealand business based out of Wellington, extraordinarily popular amongst its clients, just loved by its clients for the streamlined way in which it enables them to do their payroll and the really high-quality phone-based customer support that the team in Wellington provide to that client base. So in buying Ace Payroll, MYOB has a product that we target in that market, a payroll product. It's called NZ Payroll. And so it's a complement to a product that we have because in the payroll market, there are a much larger number of competitors than there are in the accounting market. And we believe that many of the Ace Payroll customers use MYOB accounting. And so what that's enabled us to do is to really secure those client relationships by having two components, two products that we're selling to those clients, as opposed to just one. Importantly, for any of the Ace Payroll customers out there or any customers that use our NZ Payroll product, our board also committed $5 million to building a next-generation online New Zealand payroll product. We don't think that that there are really market-leading, innovative, great options out there for New Zealand businesses to move their payroll online at the moment, and we think that that's a real opportunity. And so we've invested additional funds in R&D to make sure that that we're the market leader. We are the market leader in payroll in New Zealand, and that we remain that going forward.
But how would you respond to critics who might say that you're effectively buying sunset businesses in order to boost your customer base?
So we're not doing it to boost our customer base. The first thing is, as I just said, we're really doing it to secure and anchor relationships where we have multiple products into those clients. But the question of buying desktop software as opposed to when we all believe the future is online, those businesses that use Ace Payroll today are phenomenal businesses. They are entrepreneurs here in New Zealand who every day go out and create economic wealth. They create jobs, they pay taxes, and they're businesses that have been supported by Ace Payroll for many, many years. We love that. We love supporting New Zealand businesses. What we want to do is make sure that we're able to offer them a path to move to the cloud. And what we know is that incumbent vendor-client relationships are by far the smoothest way for a client to move online. So for us to be able to purchase Ace Payroll and commit to that client base that we're going to make the investment to build a great online product for them and then help them through that transition is by far the smoothest way for them to move online. So we think about it from the client's view. I think the perspective of the question that you're being asked is from a technologist's view. Technology is only there to serve us. It's, we use it to serve our clients. And so I think if you put a client lens on, what we're doing is a fantastic strategy because we're coupling those client relationships with a commitment to investing in go-forward technology.
I think you've answered this next question previously. It relates to sales outside of existing markets, but but for you, that's not something you're going to be focusing on.
No, you're 100% spot on. We're very focused on New Zealand and Australian businesses and accountants in practice. We love it. We love this part of the world. We love them. We certainly believe we've got enough scale, and being close to them, we don't do offshore development and so on. All of our software development is done in New Zealand and in Australia, and we really believe that the intimacy we can therefore create between our team and our clients is a distinct advantage.
Never say never, but are you ruling out that you would never look outside of those markets?
So you're 100% right, Andrew. Never say never. Why would I? There's nothing to be gained by closing down those options. What I can say is there is absolutely no plan at this point in time, and we're spending no energy and no effort to look beyond those markets. But the world changes, and so at some point in time, maybe we'll reassess that.
All right, an easier question from Anna. Sounds like you've got a busy job. How do you cope with work-life balance?
It's a great question, and maybe my wife needs to be here to answer that alongside me. I do have a busy job, but I've got to say I love my job, and I love the opportunity that MYOB has every day to help business owners across New Zealand and Australia. I hire great people around me is probably the first thing that I do. I have an amazing executive team who are very capable in each of them in their own roles, and frankly would be very capable in one another's roles as well. And we play as a team at MYOB, so it's much less about me and much more about what we collectively are able to accomplish and achieve. I find the biggest challenge in work-life balance is actually having a mobile phone. Because it's always on, which can mean that we are always on. And so we've had to put rules in place at home. I don't allow my children to bring their phones to the dinner table, and therefore I don't bring mine to the dinner table. So one of the real things for me is to work hard during the day. I get home when I'm in Sydney and make sure that I carve out a few hours to have as family time, and I leave my phone in the bedroom during those hours, and then I might go back later at night and check it again and clear out any emails.
What's the latest that you'll send texts or emails to staff?
It's the better question is probably what's the earliest, because I'm a morning person, not a night person, but I would send very few after 9 or 10 p.m. They can start at 4 or 5 a.m. though in the morning.
Right. Okay. This question comes from Tony, and he says, software as a service, as Windows 10 and Adobe recently demonstrated, can convert customers into a subscription-based rather than standalone payment, but not always the case. The need for physical disk for backup and transfer, the need for customers to use reliable features for official basis instead of just-in-time update that breaks features and workflow without warning and always on connection isn't always available everywhere. Where do you see software in 10 years' time?
Yeah, so I absolutely see software moving online. So I accept the challenges that Tony has included in his question, but categorically I think it's moving online. I think that the quality of broadband that we have is improving and will continue to improve, but I just honestly believe that the features and the benefits to the business of having that continuous online program where information and data from other sources can be incorporated that really drives efficiency outweighs the trade-offs. So it's online, and increasingly the interactions with that online software will be mobile. Just to Tony's specific question, though, we have an online platform, MYOB Account Right, and we actually built it to address some of the things that he mentioned. So, for example, you can take an online backup of your data if you would like to. So he talks about rather than the continuous updating, the need to have a backup at a point in time. We've been able to accomplish that in our cloud-based solutions, so that many of the downsides or trade-offs that he's listed there we've actually addressed. But categorically going forward, it's online, it's going to be platform-based, and it's just the way of the world.
A question from Sarah. How much debt did MYOB have before its IPO, and how much debt does it have now?
Yeah, sounds like an easy question. Let me answer it as basically as I can. If you looked at all of our debt, total debt, it was at about 1.2 billion, and now it's down to about 400 million. Within there, however, there were different tranches. So there was the senior debt, there was some mezzanine, some retail notes that we had listed on the Australian Stock Exchange. There was some PIK notes, so we didn't have to make interest payments on those. And then there were some preference shares, which had a guaranteed return. And depending on which accounting standard you use, you may or may not count those as debt. In the 1.2 billion, I'm counting all of that. We raised just over 800 million and used all of that to reduce that debt.
Okay. From Amanda, of your cloud-based customers today, what percentage are new customers, and how many moved across from an MYOB desktop product?
Yeah, great question. It's a really healthy mix of both. So we haven't released the exact number, and off the top of my head, I don't know the exact percentage, but it's almost equal components of both.
So of your customers today, how many are desktop, hybrid, and cloud?
Yeah, so we measure our customers in three ways. We say how many are online or cloud, how many are paying, so paying an ongoing subscription but still using a desktop, and how many in total are using our products. We're obviously in a quiet period now because we're past June 30, and so I can't make any updated announcements until we make our disclosures to the ASX and to ASIC. But the last public figures that we put out there were for December 31. At that point in time, we had 116,000 cloud subscribers, 505,000 paying subscribers, and 1.2 million active businesses, so businesses actively using our software.
Is that something in the future you intend to be more specific about to the market in terms of really revealing what the customer bases are and the makeup of it? Because obviously that is core to understanding the nature of your business model.
Yeah, so we will continue to put those three numbers out there so that everyone knows how many cloud subscribers we have, how many total subscribers we have, and how many active users we have using our software. Absolutely. And those are the figures, again, having done a very extensive roadshow, Andrew, and spoken to many fund managers around the world. Those are the numbers that people are really keen on. The economics of our business are driven by the number of paying subscribers we have, but the future sustainability of our business, everyone's really keen to understand how many cloud users we have. So we'll be disclosing both those numbers on an ongoing basis.
From Matt, does poor broadband in parts of New Zealand limit uptake of cloud computing and software as a service?
Yeah, it's a great question, Matt. And let's be honest, we need to improve broadband right round the country. And you know, the ultra-fast broadband initiative, the rural initiatives that the government have put in place, bring them on because we have to have it. You know, New Zealand is a nation of very creative entrepreneurs, geographically dislocated from major markets, but the online world means that New Zealand entrepreneurs can really take and sell their wares to the world far more effectively than ever before. And honestly, it brings the best of both worlds to a place like New Zealand. But it is dependent on the fact that we have reliable broadband right around the country.
Right, here's a good specific customer inquiry from an NBR reader. We use MYOB EXO. When will it go into the cloud? Our server runs Windows Server 2003, and we're currently in no man's land as to what to do, as we don't want to upgrade the server as well as upgrade to Windows Server 2012.
Yeah, great question, and I've got a great answer for them as well. So just so that everyone's aware, MYOB XO is our medium enterprise ERP solution. So it's really targeted at businesses, maybe at 20, 30, 40 employees, up to 200, 300, 400 employees. So it is a full ERP system. In January this year, we launched MYOB Advanced. It is a pure cloud-based ERP system, so that it is if you like, similar functions to MYOB XO, but it is a browser-based, cloud-based application. So I'd encourage them to contact their local business partner and ask them about MYOB Advanced, because we have an option available for them right now.
and quote the Tim Reid offering, and they might do a special deal as well.
Well, I didn't say that, Andrew. That was you.
From John, talking about staff, how many staff does MYOB have in New Zealand?
We've got about 350, very active, very proud and awesome team members here in New Zealand, spread predominantly across our offices in Auckland and Christchurch.
Are you planning on increasing that?
Yeah, and we have increased it and continue to increase it. So we're hiring right now. I was just down with the team in Christchurch last night and we were talking about how we're going to fit everyone with the desks. We've actually had to open a second office in Christchurch just because of the amount of employment that we're creating in that city.
Okay. Question from Brett. What's the first site or service you look at on waking up?
That's a great question. Look, the first thing that I do is probably check my email. The second is Twitter.
What do you like to tweet about?
I like to tweet about business. I like to share great business stories. I like to tweet about the way in which politics impacts business because, creating a stable economic environment. I had lunch with Bill English last week and we were talking about this, the ability to create certainty for business owners. And politicians have a unique ability to create confidence out there in consumers, which affects local businesses, but they also have the ability to create confidence in the business environment so that people are willing to invest. And, we've all seen the success of the New Zealand economy over recent years. Sometimes politicians don't get enough credit when they do great work. There's been a huge amount of great work that New Zealand entrepreneurs have done, but there's also been a great business environment that's been created here in the last few years to enable them to get on with their work.
Are you an avid reader?
I am an avid reader of business. I'm not an avid reader of fiction, although I can tell you right now that my 9-year-old son and I are taking turns at reading the Harry Potter series to one another. It's my third child and the third time that I've done this. And so right now I'm right into the Prisoner of Azkaban.
On the business side? What's the best read in the last year or two that stands out for you?
So I like to read about research in business, and McKinsey Quarterly and HBR are my favourite sources of information. They've both done a great job adapting their publishing to an online world. Really short, sharp pieces, very relevant pieces. You can pick up on themes and follow themes through their research, but you can also just find some real nuggets of gold.
And finally, from Rob, what keeps you awake at night?
I actually sleep very well, Rob. So I'm one of those people who puts my head on the pillow and I'm asleep within minutes. Generally speaking, I feel pretty good about the day. I like to get up, I exercise in the morning, I work hard, I spend time with my family, and when I go to bed, I'm out like a light.
Tim Reid, thanks for joining us, MYOB Chief Executive here on NBR Radio.
NBR Radio. Free to air online with business news you can use.
To the Chinese markets, Chinese investors are reliving the Wall Street crash of 1929, despite the frantic efforts of authorities to stem a share market meltdown. Among the latest measures to prevent the turmoil in stock markets from spreading to the wider economy, including a ban on shareholders and executives who own more than 5% of a company's shares from selling their holdings for the next 6 months. But already, the contagion has spread from domestic stock exchanges to Hong Kong, where the main Hang Seng Index fell 6.1%, wiping out all of its gains for the year, as well to currency and commodities markets. For example, copper dropped 1.2% to a fresh 6-year low, and Brent crude futures, the global oil benchmark, fell as low as $55.10 a barrel before recovering in later trading. The Australian dollar, which often trades in line with commodity market sentiment, was among the worst performing currencies in Asia, falling 0.4% against its US counterpart. In other markets, Japan's Nikkei 225 stock average fell 3.1%. Australia's S&P ASX 200 fell 2%. South Korea's KOSPI composite was down 1.2%. In China, the benchmark Shanghai Composite Index ended 5.9% lower yesterday after falling as much as 8.2% early in the session. The drop means 3.5 trillion yuan, or $565 billion in market value, has been erased since a mid-high June, or 1/3 of total capitalisation. The government has rolled out one measure after another to stem the rot, which has wiped out roughly $4.1 trillion in value from China's equities. But rather than reinsure investors, the frenzy appears to have heightened anxiety. On Tuesday, the most recent day for which data is available, investors pulled out 98.3 billion yuan of shares purchased with borrowed money on the Shanghai exchange, following nearly 100 billion yuan of such shares the previous day. A spokesman for the China Securities Regulatory Commission, Deng Yi, described the market mood as panic sentiment. Nearly half of the 2,800 listed stocks are in trading halts, with authorities making little effort to assess whether this is justified. The rules for insurers to buy blue-chip stocks have been erased, and state-owned firms were told not to sell their holdings in publicly listed arms. The CSRC said the China Securities Finance Corp, a commission unit that provides financing for margin trading, would increase purchases of small-cap stocks. The People's Bank of China has refrained from directly purchasing beaten-down shares, but is promising what people close to the bank said would be unlimited liquidity support to China Securities Finance Corp, a company owned by the securities regulator, to feed funds to brokerages for such buying. On Wednesday, the securities regulator said the company is extending 260 billion yuan in credit from the central bank to 21 big securities firms to buy stocks. Bloomberg reports these so far unsuccessful attempts to prop up the market closely mirrors the efforts of the US banking system to bail out the Dow Jones Index during the Wall Street crash in 1929. JP Morgan and several other top financial firms agreed to pull resources and buy up shares to put a floor under prices. It happened following a similar drop of around 30% in the Dow. These efforts only had the briefest of effects on the index, and the US was eventually plunged into the Great Depression. To court news, Kirsten Patterson says giving evidence in the High Court just after her former boss Craig Norgate died was a poignant time. She was the former New Zealand Institute of Chartered Accountants Chief Operating Officer. At the same time, Mr Norgate was its Chief Executive. Rival accountancy organisation CPA Australia is suing the Institute, which has since merged with its Australian counterpart, for defamation, based partly on two speeches by Ms Patterson and statements by Mr Norgate reported in NBR. Ms Patterson was visibly distressed during her evidence after coming across a photo of Mr Norgate among the documents. She said afterwards he was instrumental in the merger process for Chartered Accountants Australia and New Zealand. Ms Patterson is now CAA NZ's New Zealand country manager. She said, "It's a huge loss. I will miss him and Mrs Council," adding that they'd kept in contact since his departure from the Institute and shared a love of rugby. Before joining the accounting body, Ms Patterson worked for the New Zealand Rugby Union as its corporate services general manager. Mr Norgate was a director of the New Zealand Rugby Football Union, on the Taranaki Rugby Football Union, and had been a director and investor in the Chiefs. Ms Patterson said, "We continue to communicate on matters of national importance," adding that she is a Crusaders supporter.
NBR Radio, Thursday the 9th of July. I'm Andrew Patterson, and with me, Jenny Ruth. Jenny, you've been looking at Cavalier, a company that's had all sorts of problems over the last year, but it has appointed a new chair, and they actually believe that the company's fortunes could be turned around.
Yes. Sarah Hayden, the new chair of Cavalier, says that she wouldn't have accepted the job if she didn't believe that it can be turned around. She's replacing Alan Jones, who's chaired Cavalier since 2004, and he was the managing director before that since 1993. So she's replacing someone who's been there an awful long time. However, in the last few years, the company's fortunes have been pretty bad. Their mainstream wall carpets, you would know the Cavalier Bremworth brand, it's been falling out of favour. They've faced all sorts of macro conditions, such as a very high New Zealand dollar against the Australian dollar. It's made it very hard to sell into Australia. And the company's carrying too much debt. It's carrying very high levels of inventory. It's really looking a bit sick.
Yeah, and in fact, that's been reflected in the share price, hasn't it, which has plummeted all the way from $2 to around 35 cents at the moment.
Yes, and one of the things I was interested in was how much influence the Bank of New Zealand, which is its bank, had on this restructuring, because they've also appointed 3 new directors. Now, Ms. Hayden admits that this is her first public, it's the first role that she's had as chair of a publicly listed company. The other 3 new directors, she has been on the board since 2012, so she's at least got some board experience. The other 3 have not previously been directors of NZX-listed companies. I was interested in how much influence BNZ had on these events. Ms. Hayden says none.
What does she believe is going to be the strategy to turn around the company's fortunes in the future? I mean, clearly it's benefiting from a lower Australian dollar at the moment, but operationally, what else does she believe it's going to take?
Well, she believes that she's going to oversee the strategy that Mr. James has already put in place. Unfortunately, we don't have a lot of detail about that, so it's pretty hard to judge how they are going to turn around.
She did acknowledge, though, that the macroeconomic environment hasn't been kind to us, I think quoted in your piece, and that obviously comes from presumably the level of the lower level of demand for some of this product as well, too, in Australia.
Well, yes. I mean, wall carpet's just gone out of fashion, and Cavalier's had to grapple with a very high currency. If you're manufacturing in New Zealand, and the New Zealand dollar is very high, you are starting behind the eight ball.
Now, you also asked her whether or not she thought Cavalier had perhaps been too kind to its employees and whether that had prevented the carpet maker from being as flexible as it needed to be. How did she respond?
Well, she said she really couldn't answer it the way she thought I wanted it answered. She said she had actually asked herself whether the company had decided to restructure too late, whether they should have made the decision earlier. But then on the other hand, she said that it's a very brave person who reduces capacity, because once you do that, you're never going to get it back. It's lost forever.
Do you think this decision to replace Alan James perhaps has taken longer than perhaps it should have done?
Well, he's been there for an awful long time. I mean, personally, I feel really sad about this company. It's a once very proud New Zealand company producing extremely high quality products, and it is very sad to see it on such hard times.
And she noted that, didn't it, saying that it's particularly hard being a manufacturer in New Zealand at the moment, and actually calling on people to support New Zealand businesses. Well, yeah, but companies have to stand on their own 2 feet. You know, you don't just buy a company's products out of the goodness of your heart. You know, they have to present value for money and all the other things that consumers look for. Jenny Ruth with us on NBR Radio.
NBR Radio with Hotel de Brett, partying since 1959. www.hoteldebret.com. NBR Radio.
In market news, honey and cosmetics retailer Comvita has made a proposed directors' fee increase conditional on rising profits after intervention from the Shareholders Association. The company was seeking shareholder support to boost the fee pool by 22% from $450,000 to $550,000 over 2 years, but has agreed to take the second year's fee increase only if earnings per share rise 20% in the year to March 2016. Comvita chairman Neil Craig says although the company was happy with the original fee proposal, it had no problem with accommodating the association's concerns. He said, "We still believe the business is sufficiently complex and the resolution we put forward is fine," but he said the association's argument that directors and shareholders should be in the same boat was reasonable. He says we're comfortable attaching the fee to company performance and we'd rather not have a public spat on what is a relatively minor issue for us. He declined to comment on Comvita's progress towards the earnings target, but said there would be a performance update at the annual meeting, which takes place in Te Puke on July 23. Chief Executive Brett Hewlett told shareholders in his annual report that the outlook is for another good year of both sales and earnings growth. The change to the fee proposal means directors' fees will rise from $47,500 to $55,000 in the year to March 2016, but a further increase to $60,000 will be paid only if profits meet the target. The chairman's fee was due to rise from $95,000 to $110,000 in the first year and $120,000 in the second. Shareholders Association Chairman John Hawkins said the organisation wanted to see directors adequately paid for the job, but large fee increases should be aligned with shareholder returns. He said, "We think what we have arrived at in discussions with the company is a good compromise between a sound level of directors' fees in alignment with company performance going forward." Comvita last increased directors' fees in 2012. Its shares were trading today at $4.42, valuing the company's equity at $175 million. In motorsport news, racing millionaire Tony Quinn appears to have lost his bid for Taupo Motorsport Park for now. But the suspicions he voiced to NBR earlier this year have proved correct, that there was an angel investor in the wings and the track has been taken off the market. Due to the involvement of NBR rich lister Richard Izard, the company has obtained bridging finance and restructured. The bridging finance will help with unit titling the track's adjoining business park, the type of modus operandi that unsuccessful bidder Mr. Quinn has carried out at other race circuits he owns. A few weeks before the track was placed for tender, Mr. Quinn had offered to buy the debt-laden company for $3.6 million. He told shareholders he would inject cash and work his entrepreneurial magic to redevelop the park. The shareholders, who included members of the local Taupo Car Club with a lease agreement for use of the track, were unimpressed and agreed to seek other buyers. Mr. Quinn later told NBR he felt snubbed after revealing his plans to shareholders for revitalising the track. He vowed to boycott the tender process but would keep his offer before the park's financiers. Meanwhile, 80-year-old Mr. Izard is a shareholder in Taupo Motorsport Park and will become chairman of the board. His fortune is valued at about $80 million. He owns property in Auckland, a portfolio of shares, and set up Izardair in 2011 because he reportedly likes playing around in aeroplanes. He's also proved a generous philanthropist with a $1.8 million donation toward the construction of the Izard Hospice House in Taupo. A director of Taupo Motorsport Park, Tony Abbott, says he has received emails from many shareholders and people in the industry who are delighted with the arrangement. The directors say in an official statement the international tender to sell the park and business failed to reach a level to satisfy the company's objectives. According to Mr. Abbott, several tenders were received. However, post-tender negotiations failed to achieve a price that reflected the value of the complex. He said, while we were going through the tender process, we looked at several other propositions. We've restructured the business from the ground up. This has been largely made possible through an injection of bridging capital to assist with unit titling the track's adjoining business park. With a number of business park sales already completed, this has allowed for a stable financial future, and we're now looking at new management and marketing strategies. Although there will only be subtle changes to operations in the immediate future, the management team has ideas for improved and expanded offerings in mind. In media news, Paul Henry has harshly criticised the wrong columnist for a Herald on Sunday article that pointed out his show is rating lower than Sesame Street on some days. The notorious broadcaster lashed out, blaming New Zealand Herald media columnist John Drinnan, calling him that man of evil words, stupid and a twat. His co-host Hilary Barry chimed in and said silly old John is interviewing his typewriter again. The article appeared on June 28 in gossip column Spy without a byline. Spy is written by Ricardo Simic and Pebbles Hooper, who since resigned for other reasons. Mr. Drinnan does not write for the Herald on Sunday. He took to Twitter to defend himself, calling his critics confused. An article criticising Mr. Drinnan also appeared on Cameron Slater's blog Whale Oil. Media commentator Bill Ralston says this is dangerous territory for MediaWorks. He says it's a fairly dangerous thing for any TV or radio host to get stuck into someone without knowing the facts and actually getting it wrong. Normally you would expect the broadcaster to come out with a very fast apology. He said, I wouldn't expect John to sue over this, but it's still just a matter of fairness. If it happens again with someone who has a greater propensity to sue, TV3 could be out a lot of cash. NBR Radio requested comment from MediaWorks, but none was received by deadline. It's not the first time Paul Henry has lashed out at the Herald for articles about his show's ratings. A day after the show's launch in April, an article appeared in the Herald titled Paul Henry Loses Breakfast Ratings Battle. In response, Mr. Henry called the Herald a bunch of twats and said its journalism was shite. That article was also anonymously written.
NBR. With a National Business Review smartphone subscription, you can read or listen to the latest from NBR online. And for a limited time, it's free. Join NBR's Intelligent Business Network today and get free smartphone access to NBR online until August 31st. NBR doesn't do sport, weather or horoscopes, just timely, relevant, useful and insightful business news. So for business news you can use for free, visit nbr.co.nz/free.
Thursday, the 8th of July, NBR Radio. I'm Andrew Patterson, and this is Media Matters. With me, Nick Grant and Campbell Gibson. Nick, let's talk first Pebbles Hooper from the New Zealand Herald.
Yeah, I'll just very briefly recap, because I think Ms. Hooper has probably occupied enough mind space for people in New Zealand for the past week and hopefully for some time to come. But Ms. Hooper had been the co-editor of the Herald on Sunday's Spy gossip pages, but she resigned from that position this past Tuesday. It was announced that was prompted by a pretty offensive and certainly insensitive tweet that she let loose with on Saturday regarding the tragic death of the mother and 3 children in Ashburton last week, who were overcome by carbon monoxide poisoning as a result of a car left running. Yes, Ms. Hooper evoked the idea of natural selection as to why this event happened, and huge amount of social media outrage and mainstream media outrage about the tweet. And interestingly, the NZ Herald weekend editor Mariana Alexander, I was very impressed with the way she front-footed the thing. I mean, she released a statement apologising for the tweet and saying that this in no way reflected the feelings of the paper or her, and said that they'd be discussing it with Ms. Hooper in the following week. And yet, come Tuesday, it was announced by the Herald that Ms. Hooper was no longer working for them. It was couched as a resignation. I suspect she didn't have a great deal of choice over the matter, however. On a kind of a related note, we approached MediaWorks to see whether Pebble Hoopers would continue to have a regular spot on the Paul Henry Show. She's been a member of the panel on a fairly regular basis. And MediaWorks did come back and to say that Pebbles Hooper is part of a large and varied group of New Zealanders who have given up their time to appear on the Paul Henry panel. She is not scheduled to appear on the show again. It's not to say that she won't at some point, but I think it'll be quite some time before Pebbles Hooper is rehabilitated sufficiently.
She's in the sin bin for a while.
I would say so, yeah.
Now, you've been looking, Campbell, at the rules around tweets specifically. What did you garner from this situation?
Yeah, it was pretty interesting sort of discussion I had with a Twitter spokesman, and he couldn't, he had his hands tied, and also Twitter doesn't comment directly on people's tweets, so I couldn't get too much from him in terms of official comment, but the thing that he did do was he pointed me to one of Twitter's rules, which says you can't direct targeted abuse at someone, which basically means that since Pebbles made a general sort of comment about a situation, it wasn't actually deemed as breaking it. It wouldn't be seen as breaking its rules. If, on the other hand, she directed it at one of the family members, one of the deceased's family members, then in that case it would have likely broken the rules. And he pointed me to a quote from one of their recent blogs. It says, people may sometimes encounter content and behaviours you find offensive, but they are not a violation of the Twitter rules. As a platform for free expression, Twitter's overarching goal is to encourage tweets to flow. So you can take from that Twitter tries to be as open as possible, but this sort of thing, you could basically see it as the community as well as the media policing her.
But if she had directed that tweet at a member of the deceased family, then that would have been clearly against the rules.
Yeah, that's right. Yep.
Or if she'd made that tweet this Monday, she may have been in the gun as far as the harmful digital communications bill goes, which some elements of which came into force. Yeah,
because I guess this does have implications for the harmful digital communications bill, potentially.
Yeah, so for those not familiar, it's a bill that's basically intended to stop online bullying, and obviously her tweet comes at a timely, comes at quite an interesting time. So, yeah, some of the measures came into effect late last week as well as this Monday, and I spoke to NetSafe to get their take on what sort of implications it could have. And they were actually saying some things that were basically the same as Twitter, that because she hadn't directed it specifically towards anyone, it wouldn't have actually broken the law. So, yeah, like Twitter also said, though, if she had directed it at a specific person, at one of the deceased people's family members, then that would have been seen as breaking the law. And the sort of overarching and bigger picture here is whether the Twitter and the government could actually disagree on what is deemed as harmful and what is deemed as just sort of generally offensive. And NetSafe says, the Twitter and the government sort of agreeing on Pebbles Hooper's case might actually is a good example of how the social media companies and the government can agree on certain things, but I'm sure that we'll probably see a few cases in the future where they'll differ.
All right, the Herald perhaps having a bad run with its gossip columnist. Rachel Glusina also in the news. Last Friday's press council ruling over Ponygate. What did it find?
Yeah, not a great week to be a gossip columnist with an association with the Herald, it seems. Though, of course, Rachel Glusina did depart the NZ Herald not long after the incident which this press council ruling was about. Ms. Glusina is, of course, in the process of setting up some kind of joint venture platform with MediaWorks, which will presumably be gossip-based. Anyway, the Press Council received 9 complaints about an article Ms. Glusina wrote on April 23rd, which was around the Ponytail Gate incident. Essentially, Ms. Glusina was able to secure an interview with the waitress at the centre of that story and the owners of the cafe in which she worked, and the incidents of the Prime Minister's ponytail pulling took place. Now, the complaints were around the idea that Ms. Glusina had misrepresented herself initially, to the waitress at least, as a PR person who is there to prepare a general media statement that would go out to all media outlets. The Press Council found that there had indeed been elements of subterfuge, because, of course, actually Ms. Glusina's intention was to write a story for the NZ Herald exclusively. The Press Council found there were elements of subterfuge in the dealings with the principal interviewee and subject of the article, and as well as a failure to act fairly towards her. It noted that, in its view, the New Zealand Herald had generally fallen far short of the highest professional standards in this instance. And the Press Council also upheld a complaint that the New Zealand Herald failed to declare a conflict of interest, given that Ms. Glusina's brother has a commercial interest in the cafe in which the reported ponytail tugging incidents took place.
And presumably this is what allowed her to gain some extra access at a time where perhaps other journalists might not have been able to do so. Yeah,
absolutely. The waitress subsequently made it very clear that if she had known that it was Ms. Glusina who was going to be writing the article and it was for the Herald, then she wouldn't have agreed to do it. And in fact, through an intermediary, reportedly had tried to withdraw her permission for both the photo that the Herald took and the interview. But the Herald response to that was, by the time that request had been made, the paper was already coming off the printers, so they're unable to do that. Though that doesn't quite explain why it was their top story on their website the following day for quite some time.
And of course, this is the new age for the Herald, isn't it? I mean, it's going to court controversy by the nature of the sort of reporting that it's doing now, the tabloid style.
Certainly seem to. Well, the compact style, to use the Herald's preferred phrase. It certainly seems to be, and it certainly seems that the way the website is driving the journalism, and the compact format for the weekly paper in any case, does seem to have encouraged them to take a much more tabloidy kind of gossip-fueled kind of approach.
All right, also in media news this week, Simon Mersep stepping down from his afternoon slot on Radio New Zealand. What's the backstory to that?
Well, as you may remember, Simon Mersep had been a co-host on Morning Report for about 3 years, up to early last year. And then there was a kind of a shuffling of presenters. Mr. Mersep's co-host, who had been Jeff Robinson, who had been presiding over the program for 35 years. The two of them were replaced by Guy and Espiner and Susie Ferguson in that morning slot. And Mr. Robinson retired, and Mr. Mersep was moved to afternoons, which had previously been a slot that Jim Mora had been filling. Now, when Mr. Mersep came into afternoons, it ran from 1 o'clock to 5 o'clock, and it included a 4 to 5 slot called The Panel, where a couple of guests would come on and discuss issues of the day with the host. After a month or two, from what I remember, though, Jim Mora, who had been shuffled off to co-host what was it? It's the Drive program, isn't it?
Checkpoint.
Checkpoint, that's right, with
Mary Wilson.
Mary Wilson, scary Mary Wilson, who's, and I say scary in a complimentary way. I think she's great. Mr. Mersip had, as part of his afternoon duties, had been doing the panel as well, but after a wee while, that was switched out, and Mr. Mora was brought back to do it. I mean, given that, it hasn't been a great surprise that Simon Mersip is moving on now. It remains to be seen who's going to replace him. Of course, John Campbell is the name on everybody's lips. As to a possible takeover, that personally, I think he would be wasted in that slot, which is chat driven and warm and fuzzy. And while John Campbell can do that, I think he would be bored to tears. I presume he's looking for something meatier to do. So I don't know if you guys have got any thoughts about who might be in the spot. To take the over.
Noelle McCarthy is widely tipped, isn't it? I mean, she's done a lot of cover for Radio New Zealand over the years, and presumably would like to get her own slot.
Yeah, well, she would be a logical one. Also, Jesse Mulligan, for much the same reason. They've been using him as a sub for various shows over the past year or so. Or there's always that Back to the Future option of Jim Mora. Which though whether that's the forward into the future kind of message that RNZ wants to be making, don't know. Another one that someone from here at NBR is keen on is Brian Crump, who does the evenings during the week. Yeah, it's a fantastic show. Yeah.
All right, and finally, let's end with the marketing play of the week. Campbell, what have you got?
Yeah, so I came across one which was Kiwibank's campaign with Jamie Curry, and that name may not be too familiar with some of our listeners, but basically she's a huge social media personality. She appeals to teenage girls, and just to give you sort of an idea as to how much of a following she's got 10 million Facebook followers, 1.4 million YouTube followers, 500,000 Instagram followers, 360,000 Twitter followers. So she has got a lot of that social media platform locked down, basically. And what she does is she's a 18-year-old comedian who posts very quirky videos about what it's like growing up as a girl, I guess, and the sort of problems she faces at school and that sort of thing. And Kiwibank has partnered with her as they follow her move from Napier to Auckland, which is a pretty clever alignment because last time I checked, that Facebook video that Kiwibank put up had about 1.2 million views, and this sort of thing is a bit blurry sometimes because there's sometimes not a lot of clear rules about it, and viewers who are traditionally fans of her can sometimes feel like they're being, something's basically being shoved towards them inappropriately in terms of an ad just being forced on them. But this is sort of what these social media personalities do. A lot of the famous YouTube personalities line themselves up with brands, and it's quite lucrative. The makeup artists in particular make a lot of money from basically making YouTube tutorials all the time. But
not to mention all the fashion labels that can appear and everything.
It's a world that's beyond me a lot of the time.
Can't see you spending a lot of time in that world, Campbell. Yeah. All right, we'll leave it there. Thank you both for joining us. Campbell Gibson and Nick Grant, Media Matters on NBR Radio.
NBR Radio. With Clooney Restaurant, an unparalleled private dining room choice. NBR Radio.
I'm Grant Walker with Last Call. Here's what's trending on NBR Online. Tax officials proposed an Auckland investor levy pre-budget. Retail spending stalls in June. Richlister backs new Hawaii key cable. New Cavalier chairwoman says the company can be revived. Taupo Motorsport Park now off the market, so who held out? And calls to bring forward tax cuts to stimulate the economy may be premature. To find out more on our stories, log on to nbr.co.nz or stay tuned. Those stories coming up next on NBR Radio. Let's talk business strategy. The business world has seen the birth of a new breed of company, the exponential organisation that could tilt the playing field in favour of cash-strapped Kiwi entrepreneurs. The term exponential organisation was coined by Salim Ismail, a Canadian business strategist and entrepreneur who's holding a series of talks in New Zealand later this month to explain how Kiwi business leaders can tap into the phenomenon that has seen the rapid growth of disruptive companies like Airbnb and Uber. He said with digital technologies having dropped the cost of doing business, there's no reason Kiwi entrepreneurs can't tap into this and leverage off other people's capabilities to overcome the tyranny of distance and a small domestic market. He said the question is, will people take on the ambition to go for it? Mr. Ismail is a founding executive director of Singularity University, part of NASA's research centre in Silicon Valley, and helps train business leaders how to manage breakthrough technologies. He's had hands-on experience with the startup Agstro, which used social networks to find news about people's clients, colleagues and friends, bought by Google in 2010. And before that, he headed Yahoo's internal ideas incubator Brick House. The business book he co-authored last year, Exponential Organizations, Why New Organizations Are 10 Times Better, Faster, Cheaper Than Yours, has become a bestseller in the US. Mr. Ismail says the new breed of organizational structure that started emerging a few years ago is the only model that can keep up and take advantage of the rapid pace of technology-driven change. He said these companies leverage external factors such as big data, algorithms, community, crowd, user engagement, gamification, and other techniques to achieve performance benchmarks 10 times above their competitors. One example he cites is Procter & Gamble, the world's largest consumer products company, taking 300 days to develop a product from new idea to sitting on the shelves. New invention platform Quirky takes just 29 days to do the same thing. His advice to companies is to build revenue around an information-based stream, such as a plethora of companies that have sprung up with the digitising of healthcare. Then they should figure out how to drop their cost of supply by leveraging the community or crowd or tapping into others involved in that space. And because it can be too hard and time-consuming to change the culture of most medium to large-sized companies, they're better off taking the most disruptive and hard-to-manage staff members in their business and let them develop new ideas on the fringe, a model Apple has done successfully. He said another option is to find the most disruptive newcomer threatening your business and either partner with them or buy them. For more on this, nbr.co.nz. Let's go back to Christchurch, and the Green Party says the government must return a fully elected Democratic Regional Council in Canterbury immediately. Its Christchurch spokeswoman Eugenie Sage says National may not like people who get elected to local government or agree with their views, but that's not an excuse for crushing democracy. Ms Sage was one of the elected councillors kicked out by National in 2010. She was subsequently elected to Parliament. She says in 2010 Christchurch had 8 regional councillors in the former 14-member elected council. Under National's current plan, it will have 4, halving the democratic representation of the city, which provides most of ECAN's funding. National, she says, can't get rid of the Mayor of Auckland because of his position on the city rail link, or the Mayor of Wellington because she's an advocate for cycleways, so it shouldn't stymie democracy in Canterbury. She says regional democracy in Canterbury was subverted by National in 2010 to facilitate more irrigation development and thus more water pollution. The fact, she says, the government hasn't restored regional democracy, as the then Minister for the Environment Nick Smith stated it would back in 2010, is a broken promise. Ms Sage says when there was a fully elected regional council, there was far more responsiveness to public concerns about the health and state of Canterbury's waterways, biodiversity and natural environment. Yesterday's announcement that there will not be a full democratic vote for ECAN until 2019 means 4 more years of waiting for Cantabrians to get their vote back, according to Labour's environment spokeswoman Megan Woods. She says the government appointing nearly half the ECAN councillors in no way, shape or form counts as a return democracy. Calling it a transition to democracy is misleading. This is just denying Cantabrians their rights for 4 more years. She says documents released to Labour under the OIA show officials warned the government that continuing with an undemocratic ECAN would set a dangerous precedent for future changes. Ms Wood says yesterday's announcement shows the government is barrelling ahead with no concern for democracy. This raises the spectre, she says, of New Zealanders in other parts of the country being stripped of their votes as well. It's an insult to Cantabrians. Once again, the government has decided people in Canterbury cannot be trusted to make their own decisions about their future. Ms Woods has entered a private member's bill in the ballot to fully reinstate a democratically elected ECAN for next year's local government elections.
NBR Radio, Thursday the 9th of July. I'm Andrew Patterson, and with me Jenny Ruth. Jenny, you've been following the case, the key witness in the CPA defamation case, admitted that she actually got her facts wrong.
Yes, Kirsten Patterson, she was the Chief Operating Officer of the New Zealand Institute of Chartered Accountants. It's since merged with its Australian counterpart, and she's the New Zealand country manager for the new organisation. She's told the court that she got a number of things wrong, such as the fact that she had said at a conference in Christchurch and another one in Wellington that rival organisation CPA Australia didn't belong to the Global Accounting Alliance because its education standards weren't up to scratch. Now, the Global Accounting Alliance was being described in court as being the club of the former Chartered Accountant Institutes in the various countries of its members. They used to have statutory monopolies over accounting work, and only one member per country can join the GAA, and so CPA Australia's never applied, and so saying that it's not a member because its education standards up to scratch is definitely wrong.
Yeah, and this was the point made to her by CPA's barrister Ellen Galbraith. Basically, implied that she really didn't know her topic well enough to be commenting in the first place.
Yes, he very strongly made that inference in the questioning. She said that she'd been briefed at a very high level. She isn't an accountant, has never pretended to be. It is, a lot of people are saying, well, she should have been a chartered accountant to be in her position, but I mean, she's at a management level position, and there are plenty of industries where managers, aren't qualified in the particular field that their organisation covers. So I don't think that's a very fair criticism of her. However, she did get a number of things wrong as well, like she'd said that people entering the CPA training program didn't need a degree, that they were lazy, all sorts of things that really were pretty unwise. I mean, one of the points Ellen Galbraith was making was that you can promote a profession positively, but it's not usually regarded as professional to badmouth other professions or other organisations in the process.
And this is very much at the heart of this case, isn't it? Because Ellen Galbraith went on to ask her if, as a member of the Institute's management team, she'd raised any concerns about a flyer that had been distributed at universities which said that chartered accountants were first class and other types of accountants were second class. So there was very much an attempt to characterise the two groups as having very different standards.
That's exactly right, and that's at the heart of the case. CPA Australia is alleging that it's been defamed. It's also alleging that particular flyer was in breach of the Fair Trading Act.
And where does the case move to from here, Jenny?
Well, the case continues today, tomorrow. On Monday, we're expecting the former head of the Financial Markets Authority to give evidence. And then on Tuesday, we're expecting the summing up on each side.
Yeah, it'll be an interesting case to see how it's decided. Thanks for joining us, Jenny Ruth, on NBR Radio.
You're listening to NBR Radio. Upgrade to My NBR Radio with a smartphone-only subscription to NBR Online today for free and receive unlimited access to NBR Online on your smartphone until August 31st. Visit www.nbr.co.nz/free.
NBR Radio, Thursday the 9th of July. I'm Andrew Patterson. The unfolding drama on the Chinese share market has been compared with the 1929 Wall Street crash. In his editor's insight today, Neville Gibson explains why this may in fact be the case and what it means. So Neville, how would you describe what's going on in China, and perhaps most importantly, is it a crash?
Well, first I'd say there are parallels with the 1929 crash, mainly because of these unsuccessful attempts by the government to stop it collapsing. But I don't think anyone's saying it's going to be another global financial crisis or indeed a Great Depression. You could say, whatever you say about the Great Depression, the Wall Street crash was just the start of it, and it could have been prevented, many would say. But the wider impact of the China share bubble is already being felt in commodity prices. Iron ore, oil and copper have all gone down. It's also had a big impact on the Chinese currency, which, while not a freely floating one, has, it is it's allowed to trade within a band of so much. But there's no doubt that the Chinese market's a bubble. It fulfills all the four criteria. The prices were disconnected from the underlying economic fundamentals of the Chinese economy at the moment, which is slowing down. There are high levels of debt for the buying of shares. There was over-trading by thousands of millions, in fact, of small retailers, retail investors pushing up the prices. And, of course, a lot of companies are way above their true valuation. So the Chinese market fulfilled all those four conditions.
The other aspect, while the rest of the global economy might not be as connected or through those sort of transmission lines to the Chinese market, it does obviously seriously weaken confidence levels within the country, which will have to have a flow-on effect.
Yes, well, the main impact, of course, will be the small investors and just how many will lose money. I mean, obviously, with half the shares are frozen from trading at the moment. There's a whole lot of bans been put on who can sell the shares. So they're doing everything they can to stop the prices falling. But you've got 90 million investors in China, and according to one report, 2/3 of them lack a high school degree. In fact, most of those investors are out in the villages. In fact, instead of digging up potatoes or whatever they are growing, they're in there trading in shares. You haven't got a large institutional market as we know it in the West, and foreigners, of course, only take up about 2% of the market. So the losses on those investors and how it will flow through to the Chinese economy and whether they're going to be buying imported goods from New Zealand, for example, we don't really know the extent of that until the whole thing has ended.
So why has the Chinese market risen so much, and has the Chinese government been neglectful in allowing this bubble to actually occur?
Well, in essence, you could say that it really started the whole thing. When the GFC occurred in 2008-9, the Chinese government put a lot of liquidity into the market. Initially, it all went into property because Chinese attitude towards property is pretty much the same as New Zealand. And the share market was a pretty small operation and was seen as pretty much a gambling casino at that stage. Others went into a whole lot of debt instruments and that kind of thing in the shadow banking system. But, of course, both those types of investment have come off pretty severely in the past couple of years in China. So that left the stock market, and the authorities looked at this, an estimate of savings in China enormous, 20 trillion US dollars. So they basically let the market go, and for the past year the returns have gone over 100%. So that certainly got people going. They were piling in. And then, of course, there was margin debt. That's the ability to borrow to buy shares, and that's really been the critical cause of the collapse. There's so many investors are out of the money. Loans are being called up, and while they're trying to ease that, most of the investors want to get out.
Perhaps what has been most concerning is that measures to actually curb the excessive trading and new floats have both been imposed in the past week, and yet they've both failed. Why has that been the case?
Well, have a look at these measures. There's cutting interest rates to make it easier to borrow. There's a reduction in fees to buy. You've got a lot of share broker funds being directed to buy shares along with the state pension funds. So you've got all these government controls going on. But that doesn't mean to say the mentality among the investors is going to change. Half the stocks have been put on trading halts, so they're locked in there. And there's really just an air of panic in these measures as they roll out, as you suggest. The more the government tries to stop it, the more people are actually fearing that the worst. And the latest measure that happened overnight is that company executives and shareholders owning more than 5% have been prevented from selling any stock, and the big state-owned companies that have listed shares in Hong Kong as well, they're not allowed to sell in their shares in their subsidiaries.
Do you think part of the problem is because of the lack of transparency, people are even more alarmed when they see the government having to take the steps that it has been taken in the last 48 hours?
Undoubtedly that's true, because you've got to look at it from their point of view. It's not like in the West where a government intervention would be a shocking thing, and we prefer to allow markets to reach a bottom if that's possible, and this will certainly happen there. But of course the Chinese government and its reputation for 3 decades. It's been telling everyone, and people mostly believe it, that they can control the economy. They've had this enormous growth for 3 decades with a kind of floor of 7%, and they've always delivered. But as JP Morgan and the bankers discovered back in 1929, if you try and stop it, you're more likely to lose that money until we reach the bottom. And that, of course, maybe reached today, who knows?
I've seen estimates in the last few days about losses being somewhere between $2 and $4 trillion, depending on which estimate you're talking about. Surely this is going to have some sort of impact on the global economy.
Oh, it has to be, and there was a story elsewhere on the NBR website about the that confidence affecting consumers and the flow on to New Zealand suppliers, and obviously if you're in the commodities like oil, copper and iron ore, those prices are going down. That'll be positive for some aspects of the economy, but it also means that Australia is going to be in a pretty tough thing. Now, one expert on this, Morgan Stanley's Rushina Sharma, he said if the Beijing can't stop the markets tumble, there could be a sudden shift in the perception of exactly how far that economic growth might fall under the weight of too much debt. In other words, if the Chinese economy fell from around 7%, that would be quite spectacular and have a horrific effect on the world economy. We can only wait and see.
Thanks for joining us, Neville Gibson, with our Editor's Insight here on NBR Radio.
NBR. Need to hire? Try our online recruitment platform, www.nbrtalent.co.nz.
In market news, Mercer Group annual earnings fell after the stainless steel fabricator and manufacturer sold less of its Titan 500 slices than it expected. The company said in a statement earnings before interest, tax, depreciation, etc. were between $600,000 and $800,000 in the year ending June 30. That's down from EBITDA of $1 million the year earlier and means the company didn't meet its forecast for earnings growth. It said it was on track to meet its target for revenue growth of at least 10%. Mercer missed its target for the last 12 Titan 500 slices sales, making only 8 sales during the year. It's been expanding its workforce to build and manufacture the industrial food slices after acquiring the Nelson-based business in 2012. Mercer said the shortfall has had a knock-on effect such that the company will not meet the guidance. It says developing those products and markets has taken considerable resources, and while it's disappointing that the company has not achieved its targeted sales numbers, its momentum is positive. The company said it didn't meet its target for at least $3 million of headroom in its banking facility at the June 30 end of the financial year. However, it said Bank of New Zealand agreed to waive the covenants and remains supportive of the company. To help grow the Titan division, the company has established a working capital facility with Gresham Finance, which is owned by interest associated with director and shareholder Humphrey Rolleston. Government-funded Callaghan Innovation will continue to provide funding for its S-Clave sterilisation system after it achieved set milestones during the year. Separately, the company said director Richard Rooks would take over as chief executive from Richard Shepherd, who announced his departure in April. Rooks is a manager of the Rokaya Fund, which is a shareholder in Mercer. Tobin Blathwaite will step down as CFO on August 31st to become Chief Operating Officer, it said. Shares of Mercer last traded at 10 cents and have slumped 50% this year. In market news, Cavalier's new chair says she wouldn't have accepted the job if she didn't believe the company's fortunes can be revived. Sarah Hayden, who's been a director since 2012, says if I didn't believe Cavalier could be turned around, I definitely wouldn't have taken the position. Ms. Hayden also sits on the boards of the Cooperative Bank, GNS Science, Unitech Institute of Technology, and chairs New Zealand Riding for the Disabled, but says this is the first time I've stepped up to such a public role. Ms. Hayden has replaced Alan James, who chaired Cavalier since 2004 and who was its managing director before that from 1993. Her appointment was announced at the same time as 3 new directors joined the Carpet Makers board. She agreed such massive board changes are a little bit unusual and says the company went through a very robust recruitment process in selecting the new directors. None of the 3, Steve Booton, Diane McAteer and John Ray, have previously been directors of NZX-listed companies. Ms. Hayden denied Cavalier's Bank of New Zealand, had anything to do with the board upheaval. She said it's not to do with the bank, it's about what we need to do at Cavalier in order to carry out its strategy. In May, Cavalier announced its 6th successive profit downgrade, forecast a bottom-line annual loss because of asset write-downs, and the resignation of its managing director. While the December balance sheet puts Cavalier's gearing ratio at 39% with net debt of $59.1 million, the nominal equity then was nearly $92 million. Ms Hayden says, "We have too much debt, that's a fact," adding the company has been making progress on that front. However, she says the macroeconomic climate hasn't been kind to us. Ms Hayden acknowledges she faces a tough job. She says it's a difficult job, it's a difficult industry. The industry has changed significantly. One of the reasons Cavalier gave for May's downgrade was the high New Zealand dollar hurting its Australian broadloom carpet operations. The New Zealand dollar almost reached parity with the Australian dollar in April, but is currently trading just above 90 cents. Ms Hayden says thankfully it's come back down to more comfortable levels for us. And for more on this story, nbr.co.nz. In creditor news, the administration of NZF Group is finished and creditors and note holders paid, but there is still a chance a company will be sought again to take its shell. The former financial services company entered voluntary administration in May after its second reverse listing proposal fell through. Administrators McDonald Vague's final report says creditors were paid 100 cents in the dollar and note holders paid 12.7 cents in the dollar, with just over 2.58 million distributed. McDonald Vague director Perry Finnegan told NBR Radio that shareholders and note holders voted last month to get a distribution rather than push the company into liquidation. She says it was decided the best outcome for everyone was to go ahead with the administration, so we followed the trust deed and paid creditors in the order specified from the money sitting in the company's accounts. NZF had some 18 million in notes listed on the NZX's debt market, which carried an annual interest of 6% and last traded in June 2013 for a yield of 260%. The notes were priced at $21.353 for every $100. NZF shares last traded at 1 cent, valuing the company at $1.1 million. Both notes and shares were suspended from April last year. The board first suggested liquidation in April last year when restructuring plans aimed at returning the company to profitability fell over after auditor RSM Prince resigned a day after NZF was forced to restate its first half results for the second time. But the move was blocked by Nesok Custodians, which at the time held 15.8% of NZF's 18 million capital notes, as it wanted to find more value in the business. Since then, NZF has had two failed attempts at a reverse listing after Inventory Technologies abandoned its offer in April, citing commercial reasons, and an undisclosed company backed out in October last year. Ms Finnegan says, however, it's still possible a reverse listing could go ahead if the right party is interested. She says all that's left of NZF is the shell, and now the shareholders must decide to liquidate or try and look at a reverse listing option, which has failed twice before. She says, but they'll probably look at raising some funds and see if there's a last opportunity, otherwise it will be wound up. NZF Chairman Sean Joyce has been asked for comment.
Join NBR's Intelligent Business Network today. www.nbr.co.nz/subscribe. NBR.
Let's talk an investor levy for Auckland. Tax officials say Auckland's property market is uniquely focused on capital gains. In papers prepared for this year's budget, officials proposed a specific tax aimed at Auckland property investors as a way of tackling spiralling house prices and also as a revenue raiser. The investment levy would have been set at 1% of the capital value of the property. A joint Treasury Inland Revenue paper for ministers in May stated, the evidence of undertaxation is unique to Auckland among major cities, although there are areas like Queenstown where data would show similarly low yields. This relates to the increased property values and relatively flat rents being charged. Officials list in support of this the highest ever price-rent ratio in history in New Zealand, the highest ever price-income ratio in history in New Zealand, media stories of investors making very large returns from holding property, media stories of first home buyers desperate not to miss out at an auction and see prices move higher and therefore bidding whatever it takes. Anecdotal stories of foreign buyers buying multiple properties in short time frames with little due diligence. International and domestic evidence that most housing investors simply extrapolate recent returns and the expectations of future returns and extremely high recent returns in Auckland, and the high rate of change in an environment where it's hard to pinpoint new fundamental information justifying large price changes. Most of these factors apply to owner-occupied homes as well as investment property, and there's a pointed comment from officials that we restricted our policy options to those targeted at investors only because you requested those options. It said the greatest tax advantage in housing remains the non-taxation of imputed rent for an owner-occupier financing ownership with equity. Ministers were told buyers, be they first home buyers or investors, are buying properties at a time of historically low rental yields. This is not only a matter for investors. First home buyers are still keen to exit renting despite those low rents, the report points out. Now for more on this, nbr.co.nz. Let's talk Twitter. Last Saturday's infamous tweet by socialite Pebbles Hooper may not have breached Twitter's terms and conditions, even though it caused a lot of outrage and forced her resignation from the New Zealand Herald. The social media website says it does not comment directly on users' tweets, but referred NBR Radio to this rule in its terms and conditions. Targeted abuse. You may not engage in targeted abuse or harassment. Some of the factors that we take into account when determining what conduct is considered to be targeted abuse or harassment are: if you're sending messages to a user from multiple accounts, if the sole purpose of your account is to send abusive messages to others, if the reported behaviour is one-sided or include threats. A Twitter spokesman says if a person directs abuse towards a specific person, such as those of a deceased person's family, that would be considered harassment. However, a non-targeted and general tweet is acceptable. On Saturday, Ms Hooper posted a tweet that said the death of an Ashburton family from car fumes was natural selection, prompting mainstream media and social media outrage. Subsequently, she resigned from her positions at the New Zealand Herald and deleted her Twitter account. The Twitter spokesperson says it takes online safety and hate speech very seriously. He says Twitter is not the wild, wild west. But he says Twitter does everything we can to protect our users' voice. He points to a recent blog post by Twitter Australia Director of Public Policy Julie Inman-Grant, which says users of the site may sometimes encounter content and behaviours you find offensive, but that are not in violation of the Twitter rules. He says, as a platform for free expression, Twitter's overarching goal is to encourage tweets to flow. Twitter relies on its community to report rule-breaking tweets. Flagged tweets are then considered by 24/7 human safety teams from around the world. Tweet or accounts can be removed within minutes, the spokesman says. Users can also block, ignore and mute other users as well. Some measures of the contentious Harmful Digital Communications Bill came into effect late last week, possibly putting Ms Hooper's tweet under the microscope. NetSafe, often mentioned as the preferred agency for the law, says the tweet is a difficult one. NetSafe Executive Director Martin Cocker told NBR it's a difficult question, but on the surface it wouldn't appear to qualify. I say that, he says, because the Harmful Digital Communications Bill is defined as communications aimed at an individual to harm that individual. If it's aimed at a person and that person's harmed, something can be done, but if it's a general comment that's offensive, it's protected speech. He says it's arguable that she targeted the victims, but someone who is deceased wouldn't qualify under the law. He says it's one of those things where it's offensive and people find it upsetting, but it probably won't pass. In business news, M2 New Zealand Chief Executive Mark Callender confirms industry rumours that job cuts are underway. The Melbourne-based M2 bought Callplus Group, now M2 New Zealand, in April for $250 million or one times revenue. But while the new owner has its knife out, Mr Callender indicates it's more of a trim than a slicing. Mr Callender told NBR M2 is consulting with team members regarding some structural changes to the New Zealand business. Around 25 jobs may be impacted across the New Zealand business, mainly in finance and admin. A number of these positions will be moved to the Australian head office, and there are opportunities for team members to relocate. Mr Callender says M2 New Zealand has 500 staff, the same number he reported when M2 bought Callplus Group in April. The M2 New Zealand stable includes business ISP Callplus, plus the consumer brands Slingshot and Orcon and Flip. Mr Callender says the company has 220,000 customers. Independent IDC research puts its market share at 15%, he says. A recently released Commerce Commission annual telecommunications monitoring report for 2015 puts it at 13% behind Spark on 49% and Vodafone 32%. The report only covers up to June last year and notes M2's 15% claim. The chief executive says under its new owner, M2 New Zealand is shooting for 25% of the market. It's lost its key point of differentiation, however. On June 24, M2 unexpectedly settled the Global Mode case ahead of a High Court trial. Sky TV, TVNZ, Spark and MediaWorks dropped their legal action in return for M2 dropping the controversial service. Parties on both sides have refused comment, citing a confidentiality clause. ASX-listed M2 has a market cap just under 2 billion Australian dollars. It recently pulled out of the running to buy Australia's largest independent ISP, iNet, a move that would have roughly doubled its size. In April, it lost the Dallas Buyers Club copyright case and decided not to appeal.
NBR Radio with Hotel de Brett, partying since 1959. www.hoteldebrett.com. NBR Radio.
In court news, the Attorney General's appeal to send Kim.com's computers and other devices to the US continued in the Court of Appeal today, with the Crown arguing for cloned devices and their passwords to be released to the US. Last December, the court ruled the search warrants executed in the high-profile 2012 raid on the internet entrepreneur were valid, although Chief Justice Sean Elias issued a dissenting view. Appearing in the Court of Appeal before Justices Tony Randerson, Linton Stevens and Douglas White today, Merrin Cook from the Crown Law Office sought to quash restrictions on sending the devices to the US. .com and his co-accused Finn Batato, Matthias Ortman and Bram van der Kolk tried to have the warrants ruled invalid as they attempt to head off the US federal government's bid to extradite them to the US, where they face charges of conspiracy to operate websites used to illegally distribute copyrighted material. They're currently separately appealing the date of their extradition hearing, which is set down for September. Appearing for .com, Ron Mansfield says there was no opposition to the 2013 clones of computers and other devices being sent to the US, provided they were stripped of personal and irrelevant material before leaving New Zealand shores. The Crown opposes this, as it is impractical for New Zealand authorities to do so, and under the Mutual Assistance in Criminal Matters Act, it cannot recover costs from the US if it did so. Earlier material sent to the US, known as the 2012 clones, is inaccessible to US authorities, as New Zealand police are not allowed to release the passwords for the encrypted material. The Crown is seeking the restrictions on the police releasing the passwords be quashed. Mansfield argued there was no evidence before the court of how hard it would be to sift through the personal material of the cloned devices, as was done for the 2012 clones already sent over. He also opposed the release of the passwords to the US. The justices reserved their decision. Let's talk cables. Big cables. For the first time, it actually looks as if the 50% Spark-owned Southern Cross cable could get some serious competition. Hawaii cable founder Remy Galasso has been trying to raise $400 million for a trans-Pacific submarine cable since 2008. Today, Hawaii signed an equity deal with SIL Long-Term Holdings, the family investment vehicle of NBR rich lister Sir Ian Edgar. Sir Ian, worth around $100 million, also serves as chairman of Forsyth Bar. Speaking to NBR Radio shortly after the deal was made public, Sir Ian would not say how much money he would put into Hawaii, but described it as substantial. He said he would also be advising the cable company and helping it bring other investors on board. Asked whether his investment was contingent on more customers coming on board, Sir Ian said, "No, we're committed." He said Hawaii would lay its 25 terabit per second Sydney Whangarei Hawaii mainland US cable by December 2017. He expected it to be cash flow positive in 3 to 5 years. Hawaii has received non-binding letters of intent from several ISPs who want to buy bandwidth once its cable is laid. It also has one firm bandwidth contract from Rians, which says it will buy $65 million worth of bandwidth over 25 years. For more on this story, nbr.co.nz. Let's talk the economy. It's been a rough few weeks for the New Zealand economy. The dairy price fell again, business and consumer confidence have slipped from recent highs, and the woes of China and Greece have been dominating headlines. Couple that with the Reserve Bank's interest rate cut last month, with the market pricing in another this month, the result is an economic outlook vastly different from earlier this year. As the economy shifts down a gear, all eyes are on the government's reaction to the downturn. Labour leader Andrew Little calls New Zealand's present economic situation a perfect storm, and the Greens have called for more spending on public transport. The timing for this debate is almost perfect. As reported by NBR yesterday, the government may have some extra pocket money to play with. The latest government financial statements show a $1.2 billion surplus for the 11 months to May. Total government revenue was $87 billion and expenses $85.5. So should the government use the spare change to stimulate the slowing economy? NBR poll participants certainly think so. Some 64% of participants say the government needs to do something to stimulate the economy, whether that be spending on infrastructure or tax cuts. But NZIER senior economist Christina Lueng says it may be premature for the government to inject stimulus at this stage, siding with the 36% of poll participants who believe things are on the right track. She says the economy is losing momentum and some uncertainty is creeping in. That's making businesses and consumers more cautious about spending. Ms. Lueng says, but in terms of business activity, that's actually holding up at high levels. It's just the growth rate is moderating. The problem is the amount of negative news, which is creating an element of uncertainty for businesses. She says in some ways it's a self-fulfilling prophecy, because once you have that element of uncertainty, people will rein in their spending, and that in turn triggers more decreases in demand. Some say bringing tax cuts forward from 2017 would stimulate and boost the economy, but it's important to keep in mind the economy is already receiving quite a sizable shot in the arm in the form of monetary stimulus from the RBNZ. CMC Markets General Manager Chris Smith told NBR Radio earlier this week the Reserve Bank is likely to cut rates 3 times by the end of the year, adding that for the July 23 meeting the market is pricing in a 100% chance of a rate cut. Ms. Lueng agrees, she says, because the Reserve Bank has indicated its focus is getting headline inflation back to 2% and on boosting growth, the expectation is there will be further rate cuts. But the RBNZ's in a tight spot. She says on the one hand it's facing softening in demand, which goes with dairy prices seeing little signs of recovery. But then you've got the Auckland housing market, which is absolutely on fire. And if you have further interest rate cuts, then that's going to just add further fuel to that fire.
You're listening to NBR Radio. Upgrade to My NBR Radio with a smartphone-only subscription to NBR Online today for free and receive unlimited access to NBR Online on your smartphone until August 31st. Visit www.nbr.co.nz/free.